This is the Alts Insights podcast hosted by AI Insight. Today we'll cover a review of private placements for the month of September 2019. Mike Kell, Senior Vice President of Business Development and Program Management, joins Laura Sexton, Senior Director of Program Management at AI Insight to discuss key findings and market insights.
Welcome to the Alts Insights podcast, a look at the latest trends we're seeing in the alternative investment universe. AI Insight covers over 200 non-traded alternative investment funds representing nearly $35 billion in assets and over 80 alternative strategy mutual funds representing 80% of the AUM of the alternative strategy mutual fund market.
I'm Mike Kell, Senior Vice President, Program Management and Business Development at AI Insight, and I'm joined by my counterpart, Laura Sexton, Senior Director, Program Management, to discuss our most recent private placement industry report as of September 30th, 2019. So with no further ado, Laura, give me a little bit of an update overall, kind of high level with our current private placement coverage.
Sure. Thanks, Mike. As of about September 30th, we cover 155 private placements that are currently raising capital on our platform with an aggregate target raise of $15.9 billion and an aggregate reported raise as of September 30th of $7.7 billion, or about 51.5% of their target raise. And this includes 120 additional funds that we've added to our coverage this year, which of those have had an aggregate target raise of $6.8 billion. We've also seen 87 private placements close so far in 2019. Those have raised about 92% of their target.
Great, thank you. And I think it is interesting to note on those details that over the past number of years, we've seen that. So Laura just said we have 155 private placements currently raising capital that we cover on the platform, and that number has incrementally been increasing every year for the past 10 years here at AI Insight. We look forward to that continuing because although that's the current coverage, she also referenced the fact that every day and every week, we're constantly adding more coverage, and then some of those programs close out as well. But overall, current coverage continues to increase, which is a great thing. So having said that, what are some of the main trends that you've noticed in September, specifically the month of September?
Yeah, mostly that it was slow. September was definitely slow in terms of private placements being added to our coverage, which was interesting because it came off of a strong August. So in September, only 6 new funds were added to our coverage, which was one of the slowest months we've seen in a long time. The average really, in terms of new funds added to our coverage, is about 15. So because of that, on a year-to-date basis, we're about essentially flat in terms of the funds that have been added to our coverage, although we are seeing a little bit of a ramp-up here in the early part of October.
It's kind of interesting how that works for us here at AI Insight. Just when we start running our numbers for the month and we start getting concerned that, wow, what could have happened at this particular month, why it was a little bit slower than usual, and it seems like as soon as we flip the book or the page, from one month to the next, and we get worried about the prior month, all of a sudden you have this rush of new programs coming in that we're initiating coverage on. So it's certainly something that we're always dealing with. You could have one slow month, and the next month could be a record month. I think something else to point out is the fact that last year we really had a record year from an entry perspective. And although year to date, even with the slow September, we're still on par with where we were last year. So I think overall, from an industry perspective and adding additional coverage, we're right there with our record year of last year. So it'll be interesting to see how Q4 goes. But either way, we're excited to see, how that plays out.
So
specifically, so within the private placement realm, obviously, there's all kinds of different categories based on structure, sector, et cetera, within our platform, each of which are detailed in our industry report. But which of those are increases that we've seen, increase year over year?
Sure, yeah. 1031s are still increasing, and 1031s have increased quite a bit over the last few years. So this category is still going strong in 2019. Up sort of incrementally 2% year over year on a fund basis. So the number of funds we've added to our coverage is 2%, up 2%. The funds are a little bigger with the aggregate target raise in this category up 21%. So slightly bigger funds. We still have one top sponsor in the industry, but at about 22% of the market. This is definitely less than its dominance of few years ago when it was closer to 40% of the industry. So one of the trends we're seeing here is more smaller sponsors coming back in to the space and a little bit less dominance from the top sponsor here, which is always interesting and probably good to see.
Yeah, certainly. Now, to kind of take that a step further, so specific to the 1031 side of things, what does that marketplace look like today, and how are they raising capital?
Sure. Yeah, and one thing that I think is interesting here is that back, a decade or so ago, the 1031 industry was really focused on retail. Those were a lot of the programs we saw back in, the 2010 in that era were focused on retail, and that really switched to a focus on multifamily. So half of the funds, about half the aggregate target raise of the ones that have been that are current now that have been raising capital, are focused on multifamily projects. So retail is gaining back some strength with about 10% of the funds and 10% of the aggregate raise, really after being almost obsolete in the 1031 space for a few years, kind of after the market crash and the recession. Storage and industrial are also around 10% of the industry. So it's just an interesting mix of sectors, and that switch from retail to multifamily is really the biggest trend kind of over time. Been focused on multifamily pretty strongly for the last couple of years. In terms of cash-on-cash returns, based on pro forma, the average is about 5.51%. The loan-to-value debt ratio is about 59.5%. Both of these are kind of in line with averages of over the last couple of years, so we haven't seen a lot of change there over the last couple of years, but that's sort of what the industry looks like at this point.
Great. And just, I think, one point to note specific to retail and the fact that it's gaining back a little bit. I think that, without setting off any alarms, because everybody naturally thinks how can retail be making a comeback with the likes of Amazon in the direction that consumers are going. I think that, obviously with these particular 1031s, they're extremely selective. Even, retail is a very high-level category. But, I think that it's reasonable to assume that there are select opportunities, even in that space, that have minimal impact from the likes of an Amazon or et cetera. So,
and these, I will say, these tend to be focused a lot on kind of the neighborhood retail spaces, which actually have done okay compared to the malls, which are still dealing with issues and kind of some of the further tertiary locations. But these do tend to be focused on kind of those neighborhood necessity-based shopping centers.
Yeah. Well, great. Shifting gears a little bit now. Opportunity zones. Everybody talked about it all year. Everybody's been talking about opportunity zones. There's all kinds of different databases out there. It seems like every day there's a new article around opportunity zones in this great opportunity that it presents for these investors this year. We were prepared to see kind of a big influx of opportunity zone funds come onto the platform. We certainly have seen a number of them. But I don't think that I think for many reasons, we could argue that all day long as far as the reasons why, but we think that there's certainly reasons that make it much more difficult for opportunity zone funds to be successful, predominantly in the retail channel. But having said that, talk to me a little bit about what we're seeing within the opportunity zone space on the platform year to date.
Yeah, we've seen a steady increase here over the year, kind of month by month. We've had a total of 12 so far this year added to our coverage, and those have had an aggregate target raise of about $2.1 billion. So huge range in terms of the offering amounts, strategies, and locations, kind of all over the board. The funds range in size from about $7 million to $500 million. The strategies range from very targeted to diversified. Some are blind pool, some are very specific to a certain development project. We actually had the first energy-focused opportunity fund added to the coverage in August. So in terms of raise, it has been a little slower, I think, than many had hoped. The ones that we cover have raised about $407 million, or 14.4% of their targets. But this kind of slower raise seems to be, reflected across the opportunity zone industry, not just kind of our world and our subscriber base.
A good point. So something else that, conservation easement. So there's always something that you read in the news, or there's some type of activity focused on conservation easements. I'm going to ask you in just a second to talk a little bit about what we're seeing from a platform side of things around conservation easements within the platform. I think that the one caveat that I'll make is it's hard to really opine on this until, really later into Q4 and the end of Q4, because these are programs that typically we see ramp up, in 90% at least of these funds really not only come out in Q4, but also get fully funded in Q4. So having said that, and using that as a preface for the discussion, talk a little bit about, what we're seeing and maybe some barriers that might be a little bit different this year that are going to impact the outcome of these particular programs, or could potentially impact these programs, especially in Q4.
Sure, yeah, and you're right that they do tend to be Q4 programs, but I will say even on a year-over-year basis, looking at the industry, we're down in terms of new fund coverage about 43% year-over-year, and then the aggregate target raise down about 50%. So they are Q4, but even on a year-over-year basis, it's been slow. So I think, a couple of the reasons for that. One, over the last year, there was some IRS scrutiny of the appraisal methods used to calculate the deductions for easements. So that came out, and then there were allegations against one of the largest sponsors in the industry, kind of slowed things down, especially with them. But I will say lately, we've had several sponsors we've worked with indicate that there are programs coming soon. Definitely Q4 products, a lot of them in December. So we'll be watching to see how this plays out. We've seen a little bit of a ramp here recently, but still down year over year. But things may be looking a little bit better for Q4 and especially later in Q4 in that space.
Yeah, that's great. Great points, and always considerations with these programs. On one side, there's certainly, if used properly, right, it could be certainly a great thing for the environment if the easements are done the way that they should be. But naturally, anytime you deal with a particular program that's focused on a tax benefit, there's certainly going to be some level of scrutiny about that. So hopefully, however this things come out with this most recent scrutiny and allegations, hopefully it comes out for a good thing for the industry, so that these programs can continue to exist, continue to provide those environmental benefits, as well as those tax benefits to the investors. So we certainly look forward to see how Q4 plays out, but we're cautiously optimistic, of course. So really the last topic that I want to touch on in the short time that we have is hedge funds and managed futures. Give me any kind of insights you can provide around what seems to be minimal activity in that space. And by minimal activity, I don't mean in existing funds. I mean really focused around we haven't seen more come on the platform in September. We haven't seen more come on the platform year to date. Kind of give us a little bit of clarity around maybe some considerations specific to those funds.
Yeah, I think so. We currently cover 3 hedge funds, 4 hedge fund of funds, and 5 managed futures funds on the platform. And I think there's a couple of reasons why we haven't seen much activity here in the last couple of years. And one of those is that the hedge fund and managed futures funds tend to be larger, kind of perpetual life programs, and especially the fund of funds. Those tend to be a lot larger. And our subscriber base here tends to use those funds for their allocations to these strategies as needed. So they use kind of the same fund of funds for their strategies as they needed. And historically, our subscribers haven't had a huge allocation to hedging and future strategies, so they maybe don't need as many options as they would, say, in like the real estate category, where their allocations are going to be a little higher. And I will say, too, many of our subscribers are using liquid alt strategies for their hedging and futures exposures as well. So they may get the exposure to the strategies they need there. And then the other reason might be just due to the fact that we've had a really strong bull market, a market run, and there's the perception, it's not the right perception, but there's the perception that these strategies aren't as needed as they really are. So again, we'll kind of see what happens as volatility picks back up here. But I think those are some of the reasons we really haven't seen much activity in that space at all over the last year or so. That helps.
Yeah. Hey, all great points. And I read a recent article about Harvard's endowment that really spoke exactly to that, I think they took a little bit of hit in their most recent period because of their allocation to alternatives. But, really at the end of the day, the focus of the article was that regardless of that happening, it truly is the right thing to do from a portfolio perspective and planning for the future. So all that, Laura, as always, I can't thank you enough for all that you do in bringing this additional insight to our audience today. Thank you to everybody that's able to listen, and we look forward to bringing you more valuable content in the near future. Thank you.